11 mistakes that cost buyers thousands. Some of them cost people their house entirely. Mistake number 1, getting excited before getting pre-approved. Clients, good people, excited people who spent months searching for the perfect home in summer, blazing hot with their children in tow. We had exactly the right home, and when we went to write the offer, something on their credit popped up that they had forgotten about, and they couldn't buy the home. All because they were talked into getting a pre-qualification letter, which I'm gonna explain in a minute, instead of a pre-approval letter. All of this sadness, heartbreak, wasting of time could have been avoided if they had made one different decision. Pre-qualification is a lender reviewing what you tell them and giving you a rough ballpark. A pre-approval means they have verified your income, pulled your credit, and issued a real commitment. Bottom line, get fully pre-approved before you fall in love with anything. Mistake number 2, accepting the first mortgage rate you're offered. By the time a lender hands you a number, the process already feels like a lot. Adding more calls sounds exhausting. I totally understand that. But this is one of the most financially consequential decisions in the entire transaction. And most buyers treat it like a formality. A fraction of a percentage point difference in your interest rate could mean tens of thousands of dollars over the life of a 30-year loan. Lenders are not interchangeable. Their rates, their fees, and the programs they have access to vary more than you would expect until you have actually compared a few side by side. I had a client, an ER nurse. A lender marketed to her specifically because she's a first responder. She thought she was being taken care of. The rate they gave her, 6.95%. When she shopped it, she found a lender that gave her a 6.3% interest rate. Now that may not sound like much. That is a 0.65% of 1 point difference. The difference paid over the life of the loan in interest would be $73,000. But above and beyond that, her monthly mortgage payment would have gone up $200 per month. Who wants to pay an extra $200 per month for the next 30 years just because you didn't make another phone call? The original lender actually threatened to call the seller to say that my client could not make the close of escrow date if she switched lenders. That is not a lender protecting anyone other than himself. Bottom line, get at least 3 quotes before you commit to a lender. Use the same loan scenario for each so the comparison is accurate, then make a decision. Mistake number 3, missing first-time buyer assistance programs. Most buyers assume they do not qualify for assistance programs. They never ask. That assumption costs people real money, not the monopoly kind. Every state operates a housing finance authority that offers down payment and closing cost assistance to qualifying buyers. That eligibility criteria varies greatly. Income limits, property types, first-time buyer definitions that are more forgiving than most people expect. I have seen buyers leave tens of thousands of dollars on the table simply because no one told them to look. Some loan officers may not even bring up these programs because it makes their job a little harder with more paperwork. This is not a good enough reason for you to not check if you qualify for these programs. Bottom line, don't be afraid to ask for free money. Ask your lender if you qualify for down payment assistance programs. It can make the difference with you qualifying for a house that's okay and a house that you really, really want. Mistake number 4, budgeting for the mortgage and nothing else. Your pre-approval number covers the mortgage. It doesn't cover what comes after. Property taxes, homeowners insurance, HOA dues, maintenance, unexpected repairs, utility costs, the list goes on and on and on. So out of that laundry list of things, there are 2 things I want to bring special attention to. One is you're going to live in your house, there's going to be normal wear and tear. I advise saving about 1% of the purchase price, just tuck that away in a rainy day fund, and that way you've got money accessible if there's something in your house that breaks or you need to touch up. So as an example, if your house was $400,000, you'd want to sock away $4,000 a year just to make sure you've got money in case you need it. The second thing I want to bring up is a supplemental tax bill. It never fails. I, as an agent, get this call typically 6 months after we close escrow. My clients will call me saying, oh my goodness, why do I have this really expensive tax bill in the mail? So what is it? It's you paying the previous owner's tax basis. It takes the county about 6 months to figure out what the difference is between what the previous owner paid and what you paid. And guess what? They send you a bill. Go government. So 6 months after you close escrow, you're going to get a supplemental tax bill. So before you write an offer, figure out a real monthly ownership budget. Taxes, insurance, HOA, maintenance, reserves, and ask specifically about utility history and any pending assessments. Knowing all of this will tell you what your real monthly payment will be. Mistake number 5, starting the search without knowing your non-negotiable. Searching without a clear must-have list sounds harmless, right? Until you are 3 months in and emotionally wrecked and still not sure about what you were actually looking for. Without knowing what you want, you get lost in all the options. You end up checking out homes that aren't what you're looking for. And in fact, if you are not specific, you can miss the right home for you. The non-negotiable list is not about limiting your options. It's about getting clear on what you want and getting out there and finding it. Bottom line, before the search begins, make your list of must-haves. These could be location, school district, bedroom count, commute radius. These are your musts. Everything else is negotiable. Mistake number 6, negotiating without the numbers. Whenever you make an offer on a property in real estate, you're starting a negotiation. It sounds great to say, what's the best deal I could get? But this is a very delicate situation because you do not want to offend the seller. For example, this happened not too long ago. I had a client who asked me to submit a lowball offer against my advice. The seller did not just counter at listing price, he countered $10,000 over listing price because he was offended. Before the negotiation even started, the relationship was completely damaged between buyer and the seller. Sellers and their agents remember buyers who came in with unsupported offers and are far less likely to lean in your favor if the negotiation even continues at all. When my buyers want to negotiate hard, I build the case first. Recent comparable sales, days on market, price per square foot. That foundation is what turns a wish into a position. Bottom line, base every offer on the numbers, not on what you hope the home will sell for. Your agent should be able to show you the comparable sales supporting that number before anything gets submitted. All of this information and so much more is available at no cost to you in our downloadable PDF guide. Just click the link in the description below and we'll send it right over to you. Mistake number 7, underestimating fixer-upper costs. A property that needs work can look like a real opportunity. Sometimes it is, sometimes it's not. The key is making sure the math actually holds up before you own it. Repair costs have a way of expanding past even the most honest estimate once walls come open and foundations get looked at. I had a client who loved a house, loved the location, thought it needed just a little touch-up. The minor repairs turned out to be major repairs, and the property was more of a bulldozer than a fixer. Getting contractor bids before you close is the smartest thing you can do. It is making sure the deal you think you are getting is the deal you're actually getting, and that you're not biting off more than you can chew. Bottom line, if a home needs significant work, get contractor bids before closing, not after. Know that number before you commit. Mistake number 8, skipping or waiving the home inspection. In a competitive market, removing the inspection contingency can feel like the move that gets you the home. Thinking the seller will see you as less of a pain in the rear, you are taking the home as is and not asking for repair work or a reduction in price. But the protection you give up in that moment is not worth the cost. When it goes wrong, it goes really, really wrong. What looks smooth and ready on the surface could be hiding all sorts of issues. Water damage, mold, bad wiring, or maybe even the house crumbling down around you. I have watched buyers walk away from deals mid-contract because the inspection revealed something serious enough to change everything. This is protecting you and your family from a home that was going to cost you far more than you bargained for. Bottom line, always inspect, even in a competitive market. Winning the home is not worth putting your family's health or financial security in jeopardy. Mistake number 9, assuming move-in ready means maintenance free. A well-presented home feels like a fresh start, and it can be. What it is not in any case is maintenance free. Every home requires ongoing upkeep, HVAC servicing, roof and gutter maintenance, appliance replacement, plumbing, the list goes on and on. None of that is unusual. All of it costs money. The buyers I worry about most are the ones who close on a move-in ready home and assume the work is done. Building a realistic maintenance budget before you close is just part of making sure the decision ages well. Bottom line, before closing, ask for full disclosure of the home's maintenance history and appliance ages. Save for ongoing upkeep from day one, not after the first expensive surprise arrives. Mistake 10, letting emotion drive the offer. There is something genuinely wonderful about walking into a home and feeling it. That quiet sense that this could be the one. I never want to talk anyone out of that feeling. What I do want is for that feeling to stay in its lane. I had clients who found the house they really wanted. They were first-time buyers, a little fearful, so they went to their parents for advice. Dun, dun, dun. Their parents talked them out of it, and they are still renting to this day because fear made the decision, not the number. The home they were going to buy is worth $150,000 more than they would have bought it for 4 years ago. Here's what I want you to walk away with. Almost every mistake on this list can trace itself back to this one thing, including the bonus that's yet to come. Bottom line, the impatience, the fear, the excitement that outran the preparation, emotion is allowed, it's part of this, but the decision has to come from the numbers. Bonus, making large purchases. Tragic story. We're just 3 days away before closing on a house, and the deal is dead because my client just needed that Kia. How did this happen? Here's what most buyers do not know. Your lender runs your credit a second time right before closing. It's standard practice, it's not personal. But if your debt to income ratio is shifted because you financed a car, opened a new credit card, or charged furniture for the home that you have not officially closed on yet, your approval could be revoked. I have watched this happen, and it is devastating in a way that is almost impossible to describe. The purchase felt reasonable in the moment. The consequence was losing the home entirely. The keys are not yours until they are physically in your hand. Bottom line, don't open a new credit card, don't finance anything, or make large purchases at any point during a transaction. If something feels questionable, call your lender before you do it, not after. I want to share even more crazy secrets with you in this video.